Hi, welcome to our April market forecast for Huntsville and Madison County. Happy Easter. Well, if you've been to the grocery store or if you bought any gas, you know prices are rising. If you've tried to refinance a mortgage recently, you know interest rates are up, or if you're buying a home, you're shocked. Today, our whole report is going to talk about what effect rising interest rates will have on the housing market. Let's check it out. Well, as we start our report, we see that mortgage rates have reached the highest level since 2018. This has definitely put some buyers in shock. This has definitely put a stop to home refinancing. We're going to start out by taking a quick look at our March numbers from Madison County and Huntsville, just to kind of let you know how we are. We had 785 homes sold in March, and we only have 500 homes on the market. That's important for you to remember as we go through this report. We have less than 1 month's inventory on the market in Madison County. We're averaging about 9 days on the market for a home to sell. It's actually a lot faster than that. It usually takes a couple, 3 days maybe to get all the paperwork done before we actually mark it as pending. And already 634 homes pending for the month of April. From last month, we see that the county levels are tracking very close to 21. We have not seen a reduction in activity or sales. Year over year, 19% increase for homes in all of North Alabama. That's Coleman North and east to west in North Alabama, a 10% rise in Madison County. And we're selling at about 50% faster pace than we were this time last year. Now, supplier prices, consumer prices are setting records, and that's not good for the consumer. Supplier prices, the biggest gain on record, 11.2% from a year ago. Consumer prices, the biggest increase in 1 month in over 40 years. Businesses just can't take those prices on their own. They're going to pass them on to the consumers. Federal Reserve is going to raise rates. They've already started. They expect to do it many more times this year. And they're not going to do the normal 1/4 interest rate hikes. They're expected to have half-point hikes for the rest of this year, which is going to push mortgage rates even higher. The biggest news with these mortgage rates is that we've been in a 40-year long-term decline in interest rates. And if you're a technician, if you look at charts, we're right at a level now where if rates go very much higher, we're going to break that 40-year downward trend. So we could be very close to a generational change in the trend of interest rates. We could be converting from that long 40-year decline, and we could be going to another period of increase over a long period of time. Mortgage rates have finally hit 5%, and even though historically, as you know, we've looked at it many times, that is a terrific interest rate. When you look at where we came from 10 or 15 or 20 years ago, that's still a shock for consumers, especially the millennials who have just entered the housing market over the last 5 or 6 years, because all they've ever seen is low single-digit rates. Rates got in the low twos, high twos a couple of years ago, in the threes last year, and now they're touching 5%. So today we're going to talk about what effect does rising interest rates have on home values. As you can see, this is the market action index for Madison County. We have not slowed down at all. We're almost pegging the market action index. 100 is as high as it can go. It hit 100 several times last year. We thought that might have been a top in our activity, but we were wrong. We're right back at 100 again. So our activity has not slowed, even though interest rates are at their highest level in 4 years. Now, if you're a buyer, the effect of rising interest rates means that if you have a specific home payment in mind, as 80% of home buyers do, for most buyers, when they buy a home, they make their buying decisions based on a monthly payment. And if you have a monthly payment that you want to stick to for your new home, if interest rates are going up, that means that you're going to be buying less home. For example, at 3.25% interest rates, you could have bought a $425,000 home. With rates now at 5%, it's a $350,000 home. So in less than a year, the value of the home that you can purchase has dropped by $75,000 if you're going to use the payment method. Now, what about home prices? If you're a seller, what does rising interest rates have to do for the value of your home, or if you're thinking about selling your home? Well, over the last 30 years during this long-term downtrend, we've had a half a dozen periods in time when interest rates increased by more than 1%. So we've put them on a chart here for you to look at to see what happened to home prices when interest rates rose more than 1%. If you look at those half a dozen times over the last 30 years, the average increase in interest rates was 1.5%. We've already exceeded that on this turn. But home prices did not decline. Home prices averaged an increase of 8% over those six upturns in interest rates. So that's kind of counterintuitive to what you might think. A lot of people who, especially those who are expecting a market crash, who are expecting home prices to go down, they look at rising interest rates and they assume that rising rates are going to cause prices to decline. That's not the case. Rising interest rates are not going to cause home prices to decline. We're going to take a look in a minute. The only thing that can cause prices to decline is an oversupply or too much demand. But this is kind of interesting. The 6 periods over the last 30 years when we've been in rising interest rate environments, home prices have still increased in value. As we looked at last month, the forecast from the major services for this year, the average forecast is looking for a 6.7% increase in home prices this year. And I think that's underestimated. I think we're going to be higher than that. We just don't have any slowdown yet in our market. Now, as we take a look at rising interest rates will affect demand. And we've said many times that we don't necessarily have a shortage of homes or we don't have an inventory issue. What we have is an extraordinary demand issue, not only because of all the jobs, the transitions, the way people are working from home, the millennial generation now becoming home buyers. All of that puts a lot of demand in the market. We're selling more homes this year than we did last year or we did the year before. So it's not just that we don't have homes to sell, it's we have so many people wanting to buy them. But one thing rising interest rates will do is it will put a little dent in that demand. So if we look at those same 6 periods of time over the last 30 years when rates rose by more than 1%, you can see that the number of homes sold did decline. So that's what maybe we might see over the next year or two. Maybe we see the number of homes decline, but not the pricing. Waiting on the housing market to crash, that's not a good strategy because its prices are not going to crash. We're going to take a look now. The reason that prices crashed 15 years ago is because we had so much oversupply. This is taking a look at the inventory on hand when we had the last big recession and the big market turned down. Almost 10 months of inventory on hand. And if you get that kind of oversupply, you're going to have a drop in prices. Well, look at where we are today. Last year, this is a national 1.8 months of inventory on hand. And as we mentioned in the first slide or two, in Madison County, we have less than 1 month of inventory on hand. We cannot have a price crash when we have that kind of low inventory. Now, if we ever get up to a normal market, which is 3 to 4 months of inventory, then you might start thinking that maybe you can have some price reductions in the future, but price declines are nowhere on the horizon. Our activity has not slowed at all. These are showings. So showings are what precede contracts, which precede closings. You can see that as we look over the last 5 Februaries, we are at the most rapid pace we've been in 5 years. Last year, we thought we got started off with a bang and a hurry. This year, it's even faster. More showings this February than we had last February. This is where we should start to see the market to turn if the price appreciation acceleration starts to slow. It hasn't done that yet. This will be the first indicator that the market might be slowing down a little bit. This price appreciation is not sustainable. We cannot continue to grow home prices 20% year over year. So at some point in the near future, we should see this price appreciation starting to decrease. That doesn't mean prices are going to go down. That just means that they're not going to go up as fast. So for the near future, and we're talking about for the rest of this year, you can look for prices to hold steady or even continue to rise, and I'm going to vote on continue to rise. Interest rates are going to continue to increase, and demand is going to stay very strong. This rise in interest rates will put a dent in demand, but it will not put enough dent in demand to raise our inventory to any kind of levels that would indicate we're going to have a market crash. If we can help you in any way, please reach out. If you're thinking about buying or selling, we'd love to be a resource for you. Thanks for watching and have a great month.